Very good evening to all of you. Welcome to today's practical session number 22 for the year 2024. I'm pretty sure all of you would have seen this news headline on the 4th of June, because that was the day we had the results for the election. The markets were pretty volatile, so we will be talking about it. But before we get started with it, let's get done with the basic formalities. So myself, Surjit Kakkar. Today is Saturday, 8th of June 2024. And before we move ahead, let's also get done with the formalities, which is the disclosure. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So yes, like I was talking about, I'm pretty sure all of you would have seen this news headlines, which is investors, they lose around 31 lakh crores. Now, just to put it in perspective, I know some of you might not be from India. You might be from international location where, lakhs and crores does not connect with you. So in the international, numerals, right? I'll say that 31 lakh crore is about 31,000 billion, or you can also call it as 31 trillion. And if you're more comfortable with the USD, so this is in Indian rupees, right? So I can say, the investors, they lost around 31 trillion Indian rupees in about 6 hours and, 6.5 hours. Now, if you want to put it in US dollar perspective, it's almost about 380 billion US dollars. And that is what happened on that particular day, because we had the results for the election. The markets were pretty volatile. Now, before we start looking into some examples, I'm pretty sure that, during the last session, I got a question from somebody, and that question was that, we have the election results and the markets can be pretty volatile. So what we should be doing when the markets are supposed to get volatile? We already know that an event is about to happen. And to that question, I gave you the answer. The answer was that volatility is not our enemy, volatility is our friend, right? And if you think about it, because of volatility, prices they move, and prices they move pretty fast. So those fast moves can give you quick entries. They can give you quick targets. Yes, they can also be stopped out trades. But even if the markets are not volatile, it can still be some stopped out trades. But if you think about it, volatility in a way is speeding up everything for us. And that is why I said it's more like a catalyst for us. And today I'll show you a few examples. Now, all the examples which I'll be showing you are the trading ideas that I've shared with you in the past. So I'm not picking anything which I've not shared with you. In fact, I can show you a number of examples that have not been shared with you, but they worked out really beautifully. But the problem here is, if I've not shared it in the past, you don't know how genuine that would be, whether somebody participated or somebody did not participate in that trade. But if I'm showing you something we have already planned in the past and how it worked out during that volatile week, that will give you more confidence in the strategy. So yes, if you think about it, as a let's say you're a shopaholic, right? And what you see is that you have something at discount at the mall. So if something is at discount, what do? We rush to the mall, we want to buy that stuff because now we know we can get it cheaper. uh, Look at it with the same perspective, right? We have 25% discount, we have 7.5% discount, 21% discount, 20% discount, 15% discount, 14% discount. But that does not mean we blindly buy it, right? All you know is now that today the market is at discount if I'm getting something cheap based on my trade plan, not randomly. So if I'm getting something cheap based on my trade plan, yes, I would be very interested to buy it. Why? Because today I'm getting discount on it. So let's start with few examples. So we will start with the trade that we reviewed the last session. So last session we had one trade which was getting carried forward for us, which was this. And you can see, even though the markets were pretty volatile, we just went a little deeper into the zone, and then we got a nice move up from here. Though we have still not reached our 1:1, and we talked about that this trade setup is something where we can just keep trailing onto it. So this will still remain as an open trade for us, and we will track it unless and until we get an exit on this. But you can see the one, this is session number 13th for the year 2024. The session was done on 31st of March. The last session we reviewed it and we kept it as an open trade, and now you can see it has already started moving in our favor. We are almost getting closer to 1:1, where we can make it as a break-even trade. After that, we can just keep trailing onto it because there was no fresh area for us for the target. But again, if you think about it, the market crashed so badly, but you can see the zone still held for us. Now you might say, okay, this is where the zone was, but the zone has been violated. But if you remember, this was also a weekly zone for us, and that is the reason we pushed our distal line below the weekly zone so that we have a little bit of room. And can you see that actually saved us? And that is what I've talked about many times, that when I see such situations, I always prefer to have my distal line from the intermediate time frame, because it puts your stop loss at a little better location. So you can see we just came into that zone pretty deep. The zone has definitely held, and now we have started moving out of it. Currently getting closer to about 1:1. So we'll keep it as an open trade. We'll track it for the next few days as we progress with this particular setup. Now let me bring a few more examples for you. Right, again, I'll add all these examples. I'll tell you when we did the session. These are all the examples we have taken in the past sessions, and that is what I'm showing you. So let's bring up the next one. Just give me a second. Perfect. So now this one was session number 12 for the year 2024. The session was done on 23rd of March. So the fact is, all the previous recordings are available. You can go back and check that this was planned well in advance, and you can see how beautifully it worked. Price came into the zone, even the distal line was not violated. And by yesterday, we were trading almost close to 3:1. So you can see we just came into the zone, immediately got a reaction. Really nice move. And that is what I was talking about. Volatility is basically a friend. Can you see something which was not able to come into the zone for last X number of months? Can you see this is from Feb till almost June, right? From Feb to June, we were not touching that zone, but because of that volatility, prices just rushed into that area, and in just about 3 days we are almost trading at 3:1. And if you look at it, this is also a very beautiful example of something that we call as a trap. So if you look into it, can you see that's a beautiful area of support, has been working like support, almost support, right? And now when this support would have been violated, people who were long, right, those who would have already bought, their stop losses will be placed below this area, and those stop losses will be sell orders. Now because of that volatility that we had in the market was crashing like anything. I'm pretty sure everyone would be very happy selling. So when you had this breakout, again, a lot of people would be selling. And you can see what happened to all these sellers. They are selling after a decline in price. They are selling at a cheaper price. Somebody took that advantage, and can you see now the prices have started moving up, and now all these sellers will be thinking, why only after we sell prices they move up? Because they don't realize they are making that simple novice mistake. They are selling something cheap. If you're selling something cheap, that's the biggest mistake you can do in the market. If you think about it logically, in other than stocks, everything you want to buy, you always want to buy them cheap, right? You never go to the market, okay, I like this particular item, and because I really like it, let me buy 10% expensive, let me buy 20% expensive. You don't do that. So no matter how much we love something, we always bargain for it, right? We want at a better price. And when the market is throwing those better prices to us, what we do is we get scared, right? We feel, okay, the market is gonna crash, it will go to zero, I should not be taking any trades, markets will be volatile, and we miss all those opportunities. Now I know it's very difficult to press the buy button when something like this is happening, and that is why I do these sessions, right? Even if you're not taking these trades, at least eventually when you look at a number of examples where buying at those cheap prices would have been really beneficial for you, then what is going to happen? Eventually you'll start building up that confidence in the strategy, right? You'll start maybe taking small positions to see whether it works for you or it doesn't work for you, and eventually maybe you can even scale up with your positions. So beautiful example. Again, this was uh, session number 12 for the year 2024. The session was on 23rd of March. So just in case you want to go back and watch the recorded session, that is the recorded session you can look into. Now let me show you another example. Give me a second. All right, so just a few more seconds. I'm just bringing up the next one. Perfect. So now look at this example. This was session number 21 for the year 2024. And this was done on 2nd of June 2024. And here also you can see, prices just came into the zone. We are already, we have already hit 2:1. And again, if you think about it, this is where, some of you who maybe follow chart patterns, right? You might say, okay, we had a beautiful double top, and because of this double top, we had the neckline, and at the break of the neckline, what we should be doing at the break of neckline, again, we should be selling. And can you see all these people who sold now will be thinking, only why after I sell, prices they move up, because they don't realize again that novice mistake they are making over and over again. They're selling at a cheap price, and somebody was very happy buying at those cheap prices. Now here also you can see we had our zone a little fine tuned. Even if you would have gone with your distal line, which was from the daily time frame, the zone would have still held. But I think it would be a weekly area. That is why I would have taken the stop from the weekly zone, sorry, the distal line from the weekly zone, right? Can you see we were just trying to get a little deeper into this? So that's another beautiful example, session number 21 on the 2nd of June. So again, I wanted to show you these examples that volatility is not our enemy, volatility is our friend, and you can always use it to your advantage. And that was also a question that I got the previous session. Now let me show you a few more examples. Now the examples which I'm showing you next are the trades that we have definitely taken as our examples during these practical sessions, but we did not get the entries for these one because we missed it by a few rupees or maybe few peses. So let me show you those examples as well. All right, so the next example was session number 11. So session number 11 was on the 16th of March. And here you can see we came pretty close to the zone, but we missed it maybe by a rupee or two, but exactly the same thing. You have this area, prices, they went down. People would be selling cheaper and we started moving up. Now, yes, if you wanted to have a fill on this, you can see this was also a weekly area for us. For the weekly, the proximal line was definitely a little higher. Based on the weekly, you could have got the fill. And you would still, even if you're looking at your weekly opposing zone as your target, you still have over 2:1 on this. But you can see that, it's exactly the zone where prices they came and then it started moving up. So again, a beautiful example where, having the zone a little fine tuned, we definitely missed the opportunity. But yes, on a different time frame, if you were not fine tuning it a lot, you could have got your fill on this. And again, the examples which I'm showing you are always the examples which are I've already shared with you in the past, right? I can show you n number of trades which, for which I got the fill on the 4th, but I will not be sharing those examples because I've not done the analysis with you people in advance. So the only examples I'm showing you are the ones for which we did the analysis in the past, right? Otherwise, 4th was an amazing day for MIT trades. You got n number of fills, and most of those trades are already at 2:1s, 3:1s, working really beautifully. Let me show you another example. Give me a second. Let's take another example. Oops, just a second. All right, so here is another example for you. Now, this was session number 20, which was on 26th of May. Here also you can see if I'm little zoomed out, you might even feel that probably you could have got the fill and you could have bought the exact low of that particular day. But if I zoom in, you'll see probably we missed it by a few pesos. And let me see if on the, in fact, can you see this was a zone? If you were using the upper zone, you could have got your fill. Maybe we fine-tuned it a little bit. This again might be a weekly zone. Yeah, can you see it was a weekly zone? So based on the weekly, you could have still got your fill. But since we were a little fine-tuned, we missed the trade maybe by a few pesos or maybe by a few rupees. So this is what I wanted to show you, that yes, the market definitely, just give me a second. Yes, the market definitely crashed, but that was not any crisis. That was actually a hidden opportunity for people who know when to enter the trade, right? If you're just randomly entering the market, any price, anywhere, doesn't make sense, right? You need to have patience. That is what I've been talking about. And can you see days like this is where your patience pays for you. You get prices at your levels. That is where you can participate. And you can see how amazing this works. And now talking about, whatever examples I've shared with you in the past, do we have any trade which got stopped out? None, right? I don't even have one example from this week where the zone would have got violated and I can show you, okay, see, this is a stopped out trade. So again, the question was, when the markets are volatile, we get stopped out. Now you can see I showed you n number of examples. All of these were shared with you well in advance, and not even a single one of them was a stopped out trade. All of them, they worked out beautifully. And like I also said, I also can show you n number of examples on which we got the fill on the 4th, but since they were not shared in advance, I would avoid sharing those examples. But they are almost exactly the same kind of setups, right? Markets, they crashed, came into our zone, beautifully working for us. Market, they crashed, came into our zone, beautifully working out. So this is what I wanted to show as an example, that yes, people are scared when the markets are crashing like anything, but if you look at it with a different perspective, those crashes are now giving you huge discounts. And if you're getting discounts, and if you have trade setups which are qualifying based on your trade plan, why not to try to participate in them? I know initially it will be a little bit challenging. It was the same case with me when I started learning demand and supply. When things were crashing like crazy, pressing the buy button was the most difficult thing to do. But now I have been doing it for a number of years. So when I see the markets crashing now, I'm more on the excited side, because I know today is the day where I will be getting a fill on probably a lot of opportunities. Now, people also say that don't try to catch the falling knife. The only problem is they don't know how to catch the falling knife. If you know how to do it, I just showed you a number of examples where we have already done our analysis in advance. And yes, you were able to catch that falling knife. There is nothing wrong with that. Yes, somebody who doesn't know it should not be catching those falling knives. But if you know how to do it, why not to do it? Because that will always give you the lowest risk and highest reward opportunities. So yes, that is what I wanted to start it with. That is what I wanted the session to start with, because I know this week was really, really volatile, and I know a lot of people might not have had a really nice week. But yes, if you were on the right side of it, if you know how to enter the trades, when to enter the trades, probably one of your best week, right? So that is how it is. All right, great. So that takes care of volatility, right? That takes care of, should I be taking trades when the volatility is very high? Should I be taking trades when you have some news events? Definitely yes, as long as you have a trade plan with you, right? Which takes care of that volatility in case it goes against you. So as long as you have that trade plan, you know when to enter the trades, you know where to exit the trades, you know how to manage your risk. These are the most beautiful opportunities available to you, and the opportunities the markets can throw at you. So beautiful examples from this week. So now let's get started with our trade example for today's session. And yes, I can see some questions popping into the chat. We will be taking those queries, but after we are done with our analysis. So that is how we always go. We'll first complete our analysis, and once we are done with the analysis, then we'll be looking into those queries that you people have started putting into the chat box. We'll definitely do that. All right, so let's get started. In fact, the one which I'm starting with is also a trade for which I got the entry. So here also you can see we had a zone, we came into it. So I've already entered this trade at this level. But now since we have a new zone which has formed, so we'll be looking into that new zone. Though I will be more inclined towards this lower zone, but since the upper one does not get disqualified if you do the booster scoring, so that is the reason I'll say it's still acceptable. Though it will qualify as a type 2, type 3 trade. Based on my preference, I would be more inclined towards the lower zone, but we'll go with the rule book, right? But this is the zone where, I also got this opportunity. You can see we just crashed into it, and immediately we are now moving up. If you look into it, we are probably almost at maybe 3:1 on this as well. So again, the same example on n number of symbols. We just came into our zones, hit those zones, and started moving up. And again, look at the beauty of demand and supply method. The demand supply indicator, how beautifully it identifies these areas for us. Obviously, they cannot be traded blindly. You will always have to qualify them based on your trade plan. But you can see how beautifully this indicator has been designed to identify those quality areas for you. Though, yes, they need to be qualified based on your trade plan. All right, so let's get started with our today's analysis. So whenever we talk about trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based? This week is a very beautiful example, because if you would have got into emotions, you would have never pressed those buy buttons. But if you're following your rules, you would have pressed your buy button on each and every trade where the prices were coming into your demand area. And that is why it is very, very important to keep emotions out. And like I was just saying some time back, initially when I started with demand and supply, yes, those emotions would also take over, and it was not easy for me to press the buy button. I would miss a lot of trades, but eventually, as I progressed, I started having more and more experience. I started having trust in my trade plan. Now, when we see those crashes, those are the most exciting days for me, because now I know I can press a lot of buy buttons and I can get those stocks at 10% discount, 20% discount, 15% discount at cheaper prices. So again, it will come eventually. But to do that, you will have to create a trade plan, because you'll have to follow that trade plan over and over again, so that you can see what works for you and what doesn't work for you. So yes, it is easier said than done that you need to create a trade plan, especially when you're starting with trading, or maybe starting with the new methodology. So to overcome this challenge, I have created a trade plan for you, which is basically two documents. One is your trade plan steps. You can also call it as the flow chart or the walkthrough. And the second document is the rule book. Now, this rule book is a very conservative approach. With time, with experience, if you want to make some modifications to it, those modifications can definitely be done. But at least you do have a starting point using which you can start planning your trades. So what is my step number one when it comes to planning trade? Step number one is I need to define my trade purpose. And what do we mean by trade purpose? Trade purpose implies the expected duration of the trade. And the duration is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? Because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So to overcome this challenge, that what time frames I should be using, we first define our trade purpose, because logically the longer I want to be in the trade, the bigger the time frames I should be using for my analysis, and similarly the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes. We call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, let's assume that I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if we go to page number 28 in the rule book, we have our topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. High time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2 to type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Again, minded, the table on page number 31 is for NSE, because this market is only open for about 6 hours and 15 minutes. If you're trading markets which are open for longer duration, then you can look into page number 32, where we have the table for commodities and forex. So coming back to NSE, because I want to plan monthly income trades. From here, I got to know my time frames will be monthly, weekly, daily, and 60, wherein monthly will be the higher time frame used for curve analysis. Intermediate will be weekly, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then our refining time frame will be the 60 minutes chart, which can be used for multiple purposes, like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So now we know what are the different time frames we will be using based on the purpose of trade I've selected. And in this case, my time frames are monthly, weekly, daily, and 60. So challenge number 1 taken care. I know what time frames I'll be using. I also know what analysis I'll be doing on each and every time frame. Next comes challenge number 2, and that challenge is I do know my time frames, but in this example, if you're talking about the NSE market, we have over 2000 companies listed, so humanly not possible that I sit and analyze 2000 companies every day. So what I need to do now is I need to have a process in place which can help me get a smaller list out of these 2000 companies, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 companies every day, not an easy task. So that is what we do as our step number 2. We select some companies out of this list. And how do we do that? For this, we use certain computer programs, which are called as scanners or screeners. And the way these computer programs, they basically work is we input certain conditions into them, that these are the conditions I'm looking for. And then those computer programs, they identify that what all symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a small list. Now, very important to remember, no matter what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols. Because the job of the scanner is not to tell you what you need to buy or sell. The job of the scanner is only to throw a smaller list at you. Once you have a small list, you'll have to analyze them one by one. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So let's look into a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you. And those scanners are based on some moving averages, helping you shortlist some symbols by using some, these technical indicators. Second example, if you search on my YouTube channel scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners, but you're not restricted only to these 3-4 scanner screeners. So let's look at few examples as we move ahead. So like I was talking about, that once you go to our website, under the free tab, you have stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 2 symbols for me, and the short scan is shortlisting 8 symbols for me. So very important. Just because I got these 2 symbols as a long scan, it does not mean I will blindly buy these 2. Similarly, just because I got these 8 symbols as a short scan does not mean I will blindly sell these 8. So the job of the scanner is not to tell you what you have to buy or sell. The job of the scanner was to give me a smaller list. And can you see it gave me a list of 2 plus 8, which is 10 symbols to look into. So now I don't have to analyze 2000 companies. I will just analyze these 8. And out of these 8, if anything matches with my trade plan, I have an opportunity. If I don't have anything matching with my trade plan, then nothing is available for today. Now, many times what can happen is your list might be a very small list, or maybe no results are getting generated because nothing is matching with these conditions. Or even otherwise, if you wish that, I want to look at a little bigger list so that, I can look at more opportunities, then what you have to do is, you can see that in this scanner, I've given 5 different conditions. Disable the third one, run the scan again. And I'll do exactly the same thing here. Disable the third one, run the scan again. And now you can see initially I was getting only 2 symbols, but now I have 52. And similarly, if I go to the short scan, I was having 8, but now I have 25. So I have 52 plus 25, which is 77 symbols to look into. So this is how you can get your list of symbols which you might want to analyze for that particular day. And this is not the only scanner available. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you on this particular website. Some are based on fundamental analysis, top left, candlestick patterns. If I further go down, range breakouts, bullish scan, bearish scan, then you have your intraday bearish, intraday bullish, crossovers. So this is example of one simple website where you have over 150,000 scanners available to you. Similarly, if you'll do a Google search, you'll be able to find a number of websites, a number of scanner screeners, which can help you get a smaller list. Now, in this example, you saw that we got a list of 77 symbols. Now, once you start analyzing them, few challenges which you will realize. Challenge number 1, most of these symbols, they might not have a quality demand zone or a supply zone on the lower time frame, which means you are wasting your time analyzing such symbols where no opportunities are available. Second, if some of these symbols, they do have some quality areas, those areas might be really far away from the current market price. And since they are far from the current market price, you will have a longer waiting period before the prices are back. And whatever price action develops during that waiting period, it might disqualify the trade setup by the time it is back to your zone. So these are some of the challenges we face when our scanners are not in sync with demand supply methodology. And to overcome these challenges, I have also created 2 custom built tools, which is called as the alert service and the screener. Again, I'll add, these are scanner screeners. These are not call giving or tip giving services. They just help you shortlist symbols based on demand supply zones versus conventional technical analysis or fundamental analysis. Now, for both these alerts and screener, the link to the walkthrough video is available in the description. So if you want to understand them better, you can watch those videos, you can understand them better. But I'll quickly show you examples of these as well. So if you talk about alerts, what alerts basically does is that as soon as you have a formation of a demand area or a supply area, it notifies you. So we do have demo channels for alert. We have demo channel for NSC. We have demo channel for MCX, we have demo channel for Forex. So what we do is during the trading day, we give you alerts for about half an hour. For NSE, we give you the alerts from 11:15 to 11:45. And you can see on 7th of June, which is Friday. as in when these demand and supply areas were getting formed, we were getting notified. So these are real-time notifications. So you can see that on 15 minutes chart, we had a rally-based drop on MRF. That's the proximal, that's the distal. Similarly, you can see till 11:35, we were having some alerts. I just took a screenshot till 35. If I would have scrolled down, then you would have a little bit more alerts till 11:45. But again, very important, just because you're getting these alerts that you have formation of demand and supply areas does not mean you can blindly buy or sell them. This is just helping you understand where zones are getting formed. Once you have that information, you will have to qualify those zones based on your trade plan. Only if they qualify based on your trade plan, they can be a trading opportunity. So that's alerts. And if I go to screener example, you can see here what I've done is I've added screener to one chart and I've given around 40 symbols, and I'm telling the screener that out of these 40 symbols, find the symbols where the current candle is within 1% proximity to a demand area or a supply area. So can you see now I don't have to look at all the symbols. I know these are the only symbols where I'm pretty close to a demand area or pretty close to a supply area, and I can just analyze them instead of analyzing all those 40. And similarly, you can add the screener to a number of charts and you can have a very big list. In fact, if I talk about myself, I have added this screener to all the 20, almost, I guess, 2000 plus companies which are on NSE. So I use the screener for all of them, and that is how I shortlist symbols for me, right? So I don't have to go through 2000 every day. When I do my scan, I probably look at 25 out of those 2000 plus companies. So yes, you can use different ways of doing it, but again, it's your call how you want to go about it. A number of tools are available to you. I showed you some scanners. I showed you alerts, which is based on demand supply. I showed you screener, which is based on demand supply. The process can also be as simple as I don't want to use any of these scanner screeners. I want a small list. Therefore, I'll only be analyzing my Nifty 50 stocks. Or maybe I have my own favorite list of stocks which I might want to analyze every day. So choice is yours how you want to get that small list, but you will have to use some of the other process. Otherwise, analyzing 2000 companies every day is not an easy task. Now, once you have your list, what we need to do, we need to analyze them one by one. Whatever matches with your trade plan is your opportunity. Whatever doesn't match with your trade plan, you simply skip it. So let's assume we got a list, and in that list, the very first one was ABC. So we'll start with ABC. We'll go to the lower time frame. So the question here is, what is my lower time frame? We got the answer from our step number 1. That is a monthly income trader. Our time frames were monthly, weekly, daily, and 60. And daily was my lower time frame. So here lower time frame implies daily, and on daily I need to identify a zone. By zone we mean any of these 4 structures: drop based rally, rally based rally, rally based drop, or a drop based drop. So let's go to the lower time frame. And since I have applied the demand and supply zone indicator, so I don't even have to identify the zones. Can you see the indicator does automatically for me? And based on the examples we saw, you can also see how beautifully the indicator works. And that is why I always love to rely completely against the indicator, because it also makes the process faster, easier, and much more mechanical. So if I start from the current market price, you can see just below we have this rally-based rally structure. So let's mark that. So that's our zone. We have already identified the zone. Let's also mark the entry. Oops, my bad. Yeah, let's mark the entry, stop, and back to the entry, right? So yes, step number 3 was identify a zone on the chart. Do we have a zone available? Answer is yes. Now, once you have identified the zone, like I always say, the biggest mistake demand supply traders they do initially is they find any demand area, blindly start buying. They find any supply area, blindly start selling, which is incorrect. You cannot blindly buy or sell at any demand zone or any supply zone. Once your zone has been identified, next step is to qualify it based on your trade plan. Only if it qualifies based on your trade plan, it's an opportunity for you. If it doesn't qualify based on your trade plan, then you simply skip it. So the first thing we'll check is that the zone I have identified, can it be a case of level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone that is available to us to a different area. And that is why LOTL is the very first thing we check. Now, how do we verify this? Very simple concept. If you have an intermediate time frame zone and the same zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So when your intermediate time frame zone divides into multiple zones on the lower time frame, it is referred as a case of level on top of level. Now, what do we do in such a case? In such a case, we should be making the shift if that shift is required. And from this, you can also understand that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as coinciding. So if you have a coinciding level, it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And the answer is no. You can see that you don't have any intermediate time frame zone here. In fact, your intermediate time frame zone was a little lower. That is where we went a little deeper and we have started getting the correct, this move to the upside from there. So yes, we don't have a coinciding level, and if it is not coinciding, it cannot be a case of level on top of level. So now we know it's not a case of level on top of level. This zone is not because of a gap, therefore gap rules will also not apply. It's not a structure of pivot nor authenticity, non-authentic zone, because we only take drop-based rallies and rally-based drops as pivot and non-authentic zones, and we don't even have unstable equilibrium. So none of these conditions are applicable. Now, if these conditions are not getting applied, they cannot disqualify the zone, right? Only if they get applied, then you have two possibilities, either qualified or disqualified. But if it is not getting applied, it cannot disqualify the zone. So is the zone qualified for me? The answer is yes. So now that we know the zone is qualified, the next step is we'll do our booster scoring. You can't still trade it blindly. So let's start with our boosters. So the very first one is freshness. The zone is definitely fresh. You can see after leaving the zone, price has never been back. Gets a score of 3. If you talk about strength, you can see, because we are looking into some bigger time frames like dailies, here I keep my single leg out as good. If I change it to explosive, you will see it's not an explosive move. So since it is not explosive, I can't give it a score of 2. And even for a good move, I would like to see a follow through, right? So let's say on Monday we have a nice move to the upside, continuation of that move. Then I can give it a score of 1, but currently I'll give it a score of 0. Time at the zone, we only have one candle, gets a score of 3. Reward to risk ratio, we are taking it as an assumption, gets a score of 3. Next is your location. If I go to the monthly time frame, you will see that we do have demands. Let's wait for a few seconds. We do have demand, but we don't have any supply. We have taken such scenario a number of times in the past. So what we do is we take the most recent high as the most recent pivot high, I should say. So we'll take the most recent pivot high as the reference point, and by using that, we'll draw a curve all the way to the demand. And this tells us that I'm planning my trade low on the curve. So low on the curve is definitely a good location to plan a long trade. Gets a score of 1. Now talking about the trend. Sorry, on the weekly, right? Weekly is your intermediate. So you can see that prices have hit the weekly zone. We have already started moving up, due to which one supply has already been violated. So we were in a downtrend, but now one violation of supply has converted it into sideways. As soon as the second supply gets violated, this will convert into an uptrend. And that is what I always talk about, that what is basically trend. Trend is your movement of price between demand and supply areas. So even if we were in an uptrend, it hit a demand zone, it has already started moving up. Now if it violates this downtrend gets converted into an uptrend, right? But currently we are in sideways, and sideways will be a score of 0.5. Move from the zone, we need minimum 4:1, which has not yet happened. So currently we'll give it a score of 0, but in case prices they move up first and then start coming back, we can upgrade it to a score of 2. It's not a case of level on top of level, not even coinciding, and not even trap, because I'll just show you. If I take a horizontal line wherever the proximal is, and if you start pushing it up, you can see okay kind of support resistance is still very far away, and we are currently below it, right? So we don't have anything which can make it work like a trap, and that is also the reason why I said I would be more interested in this area, which is the lower one. Because the lower one, you can see you have this beautiful area of support now, and we are sitting just right below it. So this can work much better. But yes, currently we are focused on the nearest zone. So if you look at the overall scoring, we have a score of 9 for quality, 1.5 for probability, which makes it as a, sorry, not 9, my bad. This should be 2, right? So we have 8 for quality, which makes it as medium quality and low probability trade setup. And medium quality, low probability should be done as a type 2, type 3 trade. So after applying the boosters, we got to know it's a type 2, type 3 kind of an opportunity. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll have to do a position size calculation. Whenever the prices are back, you'll have to re-verify, since the markets are not static, markets are dynamic, conditions are changing almost every other second. So you'll have to re-verify, does it still qualify based on my trade plan? If the answer is yes, you place your order based on the entry type. And once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it as a break-even trade. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based. And you can see this week has been a beautiful example where probably the market has been the most volatile in the last probably few months, or maybe even I can say in the last year or two. But still the zones, they held really well for us. And yes, even though the news was all bad, right, but for us it gave us the opportunity to capture some symbols at very cheap prices, right, at discounted prices. And again, you can see that volatility worked like a friend for us, not like an enemy for us, which is what we were talking about the last session when somebody asked me exactly the same question, that if we have volatility coming in, what we should be doing. All right, so now let's look into what do we have in the chat box. But before I do that, I would like to add, if you're still not subscribed to my channel, do ensure you subscribe to it. And if you're liking these sessions, do like the video, share it with your friends, share it with your family members. If you're on some trading group, you can also share there. And if you have some people known to you who are interested in learning trading, or they are already trading but they are looking for maybe learning a new methodology, you can share the link to my course content. You can share the link to these videos. You never know, what might help someone. All right, so let's see what do we have in the chat box. So the first one is stock name not showing. Please remove the SKU. So this is done on purpose, that I don't share the name of the symbols, and the reason for that is because these sessions are not for giving you trading opportunities. These sessions are focused on you to learn how to plan trades. So if you are learning the methodology, you can apply to any symbol. You can do your own analysis, and that is the reason I don't share the name of the symbols. I only show you examples how the analysis have to be done, because I don't want to give you any ready-made opportunities. This is for educational purpose, and by hiding the name of the symbol, it remains for educational purpose. Let us know the stock name. So already answered that. Let us know the stock name. What is the use of? Okay, so what is the use of these sessions? So these sessions are, again, like I said, it's not for giving you ready-made trading opportunities. It is for you to understand how to do the analysis. So if you're focusing on learning the analysis, that is the use. You can use it on any symbol. You can do your analysis all by yourself. So that's the use of these sessions. That learn the methodology. Symbol name is irrelevant, right? Kindly please go give target time frame for monthly, weekly, daily, hourly. So it is already there in the rule book. So if you go to the rule book, you can see that I have already given you that your ACTS stands for stop loss. So your stop loss, your entry, your target, and the position sizing, everything comes from the lower time frame. So as a monthly income trader, it has to be daily. As a weekly income trader, 60. As a daily income trader, 15. As an hourly income trader, 5 minutes. And plus there are some exceptions to it. If you're planning your trades at the best location, you can even take your targets from the intermediate time frame, right? So all these things are available in the rule book. So if you'll go through the rule book, you'll find almost all the answers that you're looking for. All right, so if I took intermediate time frame or lower time frame, which is the target, or I take, so I just answer that if you're not trading at the best location, then for the target we use the lower time frame. But if you're trading at the best location, you can even use the intermediate time frame. All right, so can you please show your Fibonacci settings, which is showing entry, SL, and reward to risk ratios? Yep, so what I'll do is I'll explain you how you can do that. So once you go to our website, you will see under free tab, you have trading analysis. So this is for I'm Groot, right? So if you click on trading analysis, you will be able to see these two videos. The first one is in English, the second one is in Hindi. So you can watch this video. Here I've explained how to do the settings of all the tools that I'm using on TradingView. So just go through it. It's just that these videos were recorded a long time back, so maybe the interface would have changed a little bit, but the settings will remain the same, right? So you can just watch those videos and do the settings. They are available to you on our website on those videos. Perfect. So that brings us to the end of today's session. Thank you so much for joining in. Next, I will be seeing you next weekend. Till then, trade safe. Enjoy your Saturday. Also enjoy your Sunday, which is going to be tomorrow. And again, a beautiful week, especially for someone who is purely taking trades based on demand and supply. And a beautiful example that volatility, again, is not your enemy. Volatility is your friend. It can give you amazing opportunities when the markets are crashing like crazy. And similarly, also keep at the back of your mind, if the markets are rallying up like crazy, that's the time to start booking your profits as well, right? If it starts coming into your supply areas. All right, so again, thank you so much for joining in. See you next time. Take care. Bye-bye.